Let's get to Paulsen. Hey, Jim, I was actually going to start with you at the Leuthold Group, Chief Investment Strategist, saying you've been so right that at this point you just need to just back up, back it off. Just say, you might, at this point, things are like Jim Cramer just said, things are getting a little crazy. I think you need to just rest on your laurels and say, and take some profits, get the hell out. I've been right. What have you got to lose from doing that? But reading your note, you're not doing that. And you make some interesting comments about election risk. You say we've spent so much money already that it's going to be tough, A, for whoever wins to spend more money, and B, it's going to be tough to raise taxes in a slow economy. So maybe we don't worry about election risk.
Well, I think that's true for a while. I mean, if the economy is still really weak, it's going to be hard to recommend any tax hike, even on the wealthy. You risk killing off animal spirits when you're already down. I think the economy is going to have to improve before there's a tax hike. And I think it's going to do that, but it's probably going to take into next year before you're going to be able to do that. And if you look at the state of fiscal situation here in this country right now, Joe, I think it's going to be really hard when you have deficit to GDP ratios that are almost unprecedented and debt to GDP ratios rising dramatically to come out with large spending programs as well. Eventually, if the economy recovers, I think it will, we'll get around to some tax hikes probably, but I'm not sure that's going to be an instant thing, coming next year, for example, even if the Democrats win tri-power.
The other thing, and you do this a lot, you look at like when unemployment might be high and you talk about, that you go back 80 years and look at what the markets have done. So in this time, you went and looked at sugar highs, or at least perceived sugar highs, and usually that's at the beginning of a bull move, not at the end.
That's exactly right. Right now, if I take the money supply growth rate less GDP growth, that's at a post-war high, and then you add to that fiscal deficit spending as a percent of GDP. Right now, they add up to 36%. That policy indicator. That policy indicator is 3.5 times greater than the policy that we delivered during the double-dip recessions of '80 and '82. It's 7 times greater than the policy stimulus we delivered after the dot-com bust, and it's twice as great as the policy stimulus we delivered in the 2008 financial crisis. If you look at that, if you look at almost every time that we have a spike in that policy indicator, monetary and fiscal surge of policy, you get not only a recovery comes in the economy, but you get the beginning of a bull market. And I still think that's where we are, Joe. I'm not saying this thing won't have pullbacks along the way. We might be due for one now, but I think that we're in the early innings of a new expansion and a new bull market. So I wouldn't want to get too cute trying to time pullbacks here this early in a new recovery.